Welcome to China Unveiled. Today we're diving deep into the shocking financial data from July, released by the People's Bank of China. Notably, almost at the same time, the central bank published an article in its mouthpiece, the Financial Times, urging the public not to overreact to fluctuations in July's credit figures. This tells us one thing: the July credit data must be pretty unfavorable, and the numbers don't lie. RMB loans didn't just stagnate, they dropped by 50 billion yuan. If banks hadn't aggressively padded the figures with 870 billion yuan in bill financing, we'd be staring at a staggering 1 trillion yuan drop in loan volume for July. Just how bad is this downturn? It's the worst performance in nearly 2 decades, marking a new low under Xi Jinping's leadership. Here's the big question. The A-share market is booming, with the Shanghai Composite nearing 3,700 points. So why isn't private credit demand riding this wave? In the past, people would have taken out consumer loans to jump into stock market opportunities. There's clearly a disconnect here. Today, we're going beyond the surface to uncover what these dismal credit figures, the worst in 20 years, reveal about the state of Chinese society. Let's break down the numbers to understand the full scope of July's credit situation. Overall, RMB loans fell by 50 billion yuan. The household sector took a hit, declining by 490 billion yuan, with short-term loans dropping by 380 billion and medium to long-term loans decreasing by 110 billion. In the corporate sector, total credit rose by 60 billion yuan, but don't be fooled. This masks major declines. Short-term loans fell by 550 billion, medium to long-term loans dropped by 260 billion, and only a massive 870 billion yuan surge in bill financing saved the day. Without it, the corporate sector's credit, short and medium to long-term loans combined, would have plummeted by 810 billion yuan. That's a striking figure, isn't it? Now let's look at the broader social financing structure for July. Total social financing grew by 1.16 trillion yuan, almost entirely driven by government bond issuance, which added 1.24 trillion yuan. As we enter the second half of the year, China's social financing structure is looking increasingly distorted. The corporate sector is flatlining, and government bonds are practically the only source of new financing. This feels eerily reminiscent of the Mao Zedong era, with the government borrowing, investing, and providing jobs through work relief programs, essentially centralizing economic activity. To be fair, social financing data often shows seasonal patterns. At quarter ends like March or June, banks typically inflate their numbers. For example, loans issued on June 30th are often repaid on July 1st. Making April and July data predictably weak. But for July to deliver the worst credit figures in nearly 20 years, that can't be brushed off as just seasonality. So, how's the central bank handling this for Xi Jinping? They quickly issued a statement in the Financial Times to control the narrative. Let me break it down in plain terms. Yes, July's credit data is underwhelming, but it's unfair to judge based on 1 month. We basically wrote off July's figures and we had no choice. At the end of June, we pushed hard to hit over 2 trillion yuan in new loans. Did we really think there was that much genuine demand? No, it was a political directive. We told banks to meet those targets, lending on June 30th only to see repayments on July 1st just to hit that 2 trillion mark. What we didn't expect was that half of that 2 trillion was artificial. When those loans were repaid on July 1st, the balance dropped by 1 trillion yuan overnight. So, July's data was doomed. But don't worry, we've got August covered with subsidized consumer loan policies. With the A-share market doing so well, this is a chance to profit. Take out loans, invest in A-shares, and you'll see returns. If loan balances don't improve in August, we'll tell banks to pad the numbers again. If anyone criticizes this month's data, we'll hit back with next month's results. Do you follow the logic? That's essentially the central bank's stance. Now, let's tie this to broader macroeconomic policies. Think about this year's subtle shift in China's economic approach. After years of relative inaction, fiscal policy is now in overdrive, with measures like childbirth subsidies and subsidized loans. Looking at July's social financing data, the reason is clear. Without fiscal intervention, the credit numbers would be beyond saving. Monetary policy has hit a wall. No matter how much the central bank cuts interest rates or releases liquidity, it's not working. The problem isn't a lack of funds. It's a lack of people and businesses willing to borrow. The central bank was even shrinking its balance sheet in the first half of this year. Why? Because there's already too much liquidity out there. Sources say bill discount rates have dropped below 1%, a clear sign of excess liquidity. Since monetary policy isn't cutting it, fiscal policy has to step up. Childbirth subsidies put money directly into people's pockets to boost consumption. Subsidized consumer loans encourage spending and arbitrage opportunities. These measures aim to spark credit demand, something only fiscal policy can do. Even Xi Jinping's high-profile anti-involution campaign in July was aimed at credit demand. For example, companies like BYD were ordered to shorten payment terms to within 60 days to support struggling suppliers. With reliable payments, suppliers can repay or renew loans, maybe even expand with new ones. If price wars in industries ease up, small businesses can avoid collapse, improve profits, and feel confident enough to invest or borrow. Xi's intentions are solid, but relying on administrative measures instead of market forces, that may limit the results. Another number in July's financial data is seriously skewed: M1. Normally a rise in M1 means people are turning idle funds into active money, a sign of a healthy economy. But July's data is puzzling. Credit demand is at its lowest in 20 years, signaling economic weakness, yet M1 surged by 5.6%, beating market expectations of 5.3%, and the gap with M2 narrowed significantly, suggesting economic strength. What's behind this? This year's government subsidies and debt resolution policies have massively boosted cash reserves held by the government, state-owned enterprises, and centrally owned enterprises. In essence, the government is borrowing heavily and hoarding cash, driving economic activity, borrowing, spending, everything. Financial data is starting to look like the government's personal ledger. But here's the catch. The government's debt issuance capacity is running low. Of this year's 11.86 trillion yuan bond issuance plan, 8.85 trillion was issued in the first half, with another 1 trillion in July. That leaves, at most, 2 months before the government runs out of bonds to issue in the fourth quarter. If economic data gets too ugly, next year's quota might be released early to prop up social financing. Otherwise, how will GDP growth hold up in the second half? China's macroeconomic path is clear, and Beijing knows the real problem: a lack of confidence. The A-share market is nearing 3,700 points, a 5-year high, but it's not drawing in retail investors. Who's fueling this rally? Institutions, private equity, and high-net-worth investors. Why? Last September's market crash scared retail investors away. Even with the Shanghai Composite nearing 3,700, retail participation is lower than it was last September. Whoever orchestrated that crash blew a golden opportunity to restore market confidence. Now, even as A-shares climb, retail investors are too cautious to jump in. It seems Xi Jinping figured out after last September that domestic capital needs somewhere to go, either real estate or the stock market. Without options, capital will try to flee the country. The last A-share bull market ended in 2015 with a brutal crash, followed by a 1 trillion USD drop in China's foreign exchange reserves in 2016. Why? An asset shortage left money with nowhere to go. Back then, the government inflated real estate to keep capital in the country. Today, real estate is a lost cause. Households are over-leveraged and the population is shrinking. To stop capital flight, the A-shares have to step up as the new reservoir. That's why the markets hit 3,600 points. I believe the A-share index will keep rising in the near term. With retail investors sitting it out, institutions and big funds are driving the index up, leaving the government with no obvious targets to harvest. China's economy is becoming increasingly unbalanced, resembling a modified planned economy. While markets like the A-shares exist, the state holds most of the power. The A-shares are now more about maintaining China's image, retaining capital, and tackling the asset shortage. Meanwhile, the government controls nearly every aspect of the economy: investment, consumption, and employment through work relief programs. The private sector is barely hanging on, struggling to even show up in social financing data. How is this different from the Mao era, when everyone worked for state-owned enterprises? If this path continues, China risks mirroring the late Soviet Union, state investments propping up superficial projects with declining efficiency, private capital sidelined, innovation and vitality fading, and capital markets reduced to policy tools for stability. Foreign exchange reserves and capital controls will be the state's last line of defense. If those fail, the RMB could become worthless. In summary, July's poor financial data can't be blamed solely on seasonal factors. It reflects a deeply imbalanced economy, with private credit demand nearly non-existent, forcing fiscal authorities to step in with subsidies. The stock market wants to be the new reservoir, but retail investors aren't biting. Xi Jinping is betting on a turnaround before the government runs out of borrowing room. Without that turnaround, China could follow the Soviet Union's path, unless an unforeseen force pushes for real structural reforms that share more benefits with the public. Otherwise, with Xi's rapid retreat from openness, tighter controls and isolation could lead China back to poverty and hardship. The direction China takes will become clear within the next 5 years. Thanks for watching and joining us on this journey to unveil China's many layers. If you found this video insightful, please give it a thumbs up, share it with others, and hit that subscribe button to stay updated. See you in the next video.